Hey everyone, and welcome to this video on President-elect Trump's tax plan. Because this is going to be a complex subject, I'm breaking this video down into several parts. This first part is going to cover his proposals for personal income taxes. In future videos, you'll see additional information on estate taxes, as well as corporate or business taxes. So the way I'd like to structure this video is to first identify whether tax cuts are a priority for this country right now. And then, assuming that it is, I'm going to break it down into the impacts that Trump's plan will have on people at different income levels to evaluate sort of its fairness, and then get into the impact on the budget deficit, as well as to the overall economy. Let's get started. So now let's take a look at just how important tax cuts are as a national priority. So when comparing the United States to other developed countries, it's actually clear that we rank almost at the bottom among those countries in terms of the revenues that are generated in taxes. So the only countries that rank below us are Chile and Mexico. But this is actually a pretty typical result for the United States. As a country, we have made a conscious choice to have government remain relatively small. It's big because we have a big economy, but as far as its influence across society, it's actually less than a lot of other countries and certainly below the average for developed countries. But nevertheless, we've made this choice to have a smaller government. And so maybe the best way to look at this is to look back in history to see if there's something unusual about the tax revenues that we're getting today versus in the past. And what we see from looking back almost 100 years is that at least since about 1950, so after the Great Depression, that we've basically had a range of between 15 and 20% of GDP that goes toward federal tax receipts. So you'll see that it is lowest when we're in a recession, and obviously people are making less money, and so there's less tax revenue. And it's at the very highest at the peak of an economy just before a recession. And what you see right now is that we're right in the middle. We're just over that 17.5%. And so what this really represents is about where we need to be if we're going to keep government at about the same levels as they have been historically. So really based on this, what we're finding is that having tax cuts is not necessarily a national priority. Now, having said that, there might be some very good reasons for having a tax cut. For example, if we're worried about the economy anyway and want to have some kind of a stimulus, a tax cut is one way of doing it. So let's take a look a little bit more closely at this tax cut because it's certainly on the national agenda for right now, and it's something that is one of the main pieces that Donald Trump wants to get enacted early in his administration. So let's take a look first at whether the tax plan that he has proposed is a fair one and how it affects different income levels. But before we can evaluate the fairness of the plan, we have to look a little bit more closely at some of its provisions. The first key one is that the number of income tax brackets is going to be reduced from that today down to only 3 at the 12, 25, and 33% level, which would effectively reduce the top rate from the current 39.6%. Another key one is that the regular standard deduction will be greatly increased. And because of this, the personal exemptions for yourself and for dependents is being removed. The plan will also cap the total amount of itemized deductions that can be claimed at $100,000 for single filers and $200,000 for joint filers. The impact of that is a little bit smaller than one might think because the standard deduction is going to be increased enough that fewer people are going to be itemizing their taxes. Another big change that sounds like it's only going to be affecting businesses and wouldn't apply here, but actually is very relevant, is that the top corporate tax rate is being reduced from 35% to 15%. Now, ordinarily, this wouldn't apply to personal income taxes, except that now there's going to be a new tax status being created that basically allows somebody who is, say, a sole proprietorship or an S corporation or some of these other entities to enjoy the 15% rate rather than the individual tax rate. And we'll talk about that a bit more later. And finally, this plan will also add a new deduction for child-independent care expenses. I'm not going to go into the details of this for right now because they're not going to be critical from a big picture point of view, but nevertheless, they will be there as well. So what I'm going to show you is that this tax plan actually does benefit all different income classes. But I still think that we need to look a little bit at the fairness of the plan in light of recent history. So one factor is that since 2007, when we had the Great Recession, families in all income levels lost wealth. However, it's only really the top 1% that have recovered since the recession overall. So it's important to look at that perspective. And in addition, the share of the wealth that the top 1% hold today is actually very high and has been increasing for a number of years. Academics will differ on exactly what that trend line looks like, but it's very clear that the trend exists. So from a public policy point of view, you need to be sensitive to any tax plan that's going to incent the rich a lot more and benefit them a lot more than other income groups. So let's take a look at the Trump tax plan and do a little bit of arithmetic to give you an idea of exactly what the benefits are going to be. I took the liberty of making some rough calculations that are based upon somebody who is a single filer and who has selected the standard deduction, and tried to model what their taxes are going to look like if they have a $25,000, $50,000, $100,000, and $1 million income. As you can see, there is tax savings that all income levels are going to benefit from with this tax plan. And you also find that it's a little bit uneven, but it starts from a range that's somewhere a little bit below 2% and rises for these examples up to about 3.5%. So at first blush, the Trump tax plan seems to be pretty reasonable. However, people who have studied the Trump tax plan with a little bit more nuance see things a little bit differently. So from the Tax Policy Foundation, which is a very respected think tank who has looked at people's deductions and filing status and many, many other factors, they found some different results. And in fact, what you find here is that the benefits of the tax plan skew greatly toward the top 1% and to the top 1/10 of 1%. So let's dig into that a little bit for a moment. What you find here is that the benefits to people who are in the bottom 80% of the country, so that's the vast majority of people in this country, are only going to see a net gain to their incomes of, say, between 1% and maybe 2% net. So that's not a whole lot. And you see it jumping to 6.6% for the top 20%. But if you drill down underneath that top 20%, you actually can see a better picture of the story. So what you find is that people who are even as high as the 95th percentile get about the same benefits as the folks who are in the top 80%. However, it starts to jump. And by the time you get to the top 1%, it jumps to 13.5% of an income gain. So what's the discrepancy? You saw the earlier figures that people in that income group, you might only see about 3 or 4%. So why the difference? Well, one of the key provisions has to do with this new tax filing status, who may be sole proprietorships and other sort of business kind of entities. And so the people who are running the study are assuming that about half of the people who are in this higher income tax group are going to be changing that filing status, because it means that instead of them taking on the new revised 33% tax rate, they're going to be taking on 15% tax rate, much, much lower. And because of the difference between the tax rate for business and the tax rate for individuals, it's going to provide a huge incentive for people to try to take that lower number. And they're going to be very aggressive about it. So currently, the Trump tax plan really doesn't get into at all about this new tax filing status, and it's going to be really critical. So going forward, everyone needs to be aware of what that's going to look like, because if it isn't going to be adjusted dramatically to make it tougher for people to call themselves a business unless they're really a business, then it's something that we shouldn't be providing to people. It's also possible that we need to make some adjustments to some of the other top tax brackets because, frankly, it does create a little bit more unfairness. So because of the 6.6% deviation for the old versus the new TOPS tax rate, even if you filed as an individual, you're still going to be getting a much, much greater benefit if you're wealthy compared to somebody who isn't. And that benefit grows the more that you're paying your taxes from the revised top tax rate. So now let's talk a bit about the impact that the Trump tax plan will have on the budget deficit. So ranges for this impact have varied a fair bit, from between $5 to $9 trillion over a 10-year period. Now, the best estimate I've seen has come from the Urban Institute, Brookings Institution Tax Policy Center. And by the way, this includes both the business tax proposals as well as the personal income tax. The whole thing is around $6.2 trillion in the first decade and $8.9 trillion in the second decade. There's a bit more of a rise because we're also paying interest on the deficit from the earlier years. They also estimate that about 3/4 of that deficit will come from the business tax portion of the plan and not the personal income tax one. For personal income taxes, that would mean that there's roughly a $1.5 trillion deficit that comes from the plan. So thinking about the deficit is also kind of important right now, and we need to be sensitive to it because this is an area of great concern. I mean, right now, the U.S. economy is sitting on just a little bit more of a deficit overall than the size of our overall economy. And that is a really good benchmark about whether we've gone past that tipping point, whether we've really gone too far with a deficit.
Another key deficit spending benchmark is whether the annual federal budget deficit exceeds 3%, which is regarded as a level that the U.S. economy can sustain. Over the last 10 years, deficit spending grew dramatically in response to the Great Recession and has only fallen below the 3% threshold over the last few years. Now, looking at the revenue decline when the tax cuts are in full effect of about $311 billion in 2020 compared to the size of our economy that year of about $20 trillion, these tax cuts will raise the deficit by another 1.5% of GDP. Now, in my opinion, it is really irresponsible increasing the deficit with permanent tax cuts now, especially when it is not in response to some national emergency, like another financial collapse, or a war that has broad support. Tax reform now should be revenue neutral. For me, I'm clearly not a fan of these tax cuts because they drag us further into an unsustainable hole of debt. However, it is important to look at how much they will stimulate the overall economy. After all, this is the biggest reason for enacting these cuts, and it is important seeing the potential good that come from them. Unfortunately, this is an area that is the least understood and has the greatest uncertainty among economists. The classic idea about a stimulus is that it will increase the size of GDP more than the dollar amount of the tax cut or additional government spending. With tax cuts, people have more money to spend, and they will use it to buy goods and services. The additional spending will increase aggregate demand and prompt businesses to hire more people to meet the production demand. This additional amount of spending beyond the value of the tax cut represents the multiplier effect. In other words, for every dollar in new spending or tax cut benefit, how much additional GDP is added to the economy. Factors that tend to increase the multiplier effect include tax cuts or new government spending that is spent right away instead of being saved. Good examples include new spending on SNAP or food stamps, or tax cuts targeting low-income groups who are more likely to spend the money. Tax cuts or credits that are targeted at new investment also have a high multiplier. Now, what can we say about the Trump tax plan for personal income taxes? The benefits seem to target the wealthy, with almost half going to the top 1% and 3/4 going to the top 20%. Under the circumstances, the benefit is akin to a tax cut for the wealthy, which the Congressional Budget Office estimates with between a 0.1 and 0.6 multiplier. it is likely the real value will be on the low end of the range because the U.S. is not in a recession, and it is more likely that higher government borrowing caused by tax cuts or spending increases will lead to higher interest rates that crowd out spending on investment and durable goods such as cars. Here, higher interest rates raise the cost of borrowing by households and businesses and cool the economy. Now, using a somewhat generous multiplier of 0.5, this would lead to a net GDP increase of about 0.8% per year. Now, this is not in itself an impressive stimulus, but in concert with other Trump stimulus proposals, it will lead to the 4% growth that President-elect Trump is seeking. The only trouble is the longer-term cost of achieving the growth rate. Is the long-term debt worth the short-term benefit?
So what do we kind of concluded from this overall? The things that jump out at me are that, number one, as a national priority, monkeying around with personal income taxes is really not a big concern. However, if you're going to be tinkering around with it, it's better to have something that benefits the working class and middle class a bit more. The Trump tax plan will have the biggest impact toward the people who have the highest income. And in particular, the part that's going to be most dramatic is having this new filing status for people who claim that they are basically a business. So it's going to be critical that anybody making policy is going to be really careful about defining that well, because there's going to be a powerful incentive for people to try to work themselves in a way with their employer or in their lives to take advantage of that benefit. And that is going to have an impact. It would mean that this overall tax plan will by far benefit the wealthiest people, and it also will mean that the tax rate for them will drop to 15%. We may want that for genuine, legitimate businesses, but we probably don't want just everybody taking advantage of that tax rate when people who are making less money are actually paying a higher tax rate. It doesn't make sense. So that's another thing to look at. Now, as far as the deficit, it looks like the deficit will go up as a result of this plan. And there's some sensitivity there for anything affecting the deficit now that our overall public debt is so great. So be conscious of that. Is that something you want? Maybe yes, maybe no. Maybe a stimulus is worth it. But for many of you people watching this, you're going to be concerned about that impact. And then finally, as far as economic stimulus, it does look like the stimulus is going to be relatively modest for this and not such a great deal. So anyway, thank you very much for watching this video. I hope to continue this discussion shortly in an upcoming video, so stay tuned for that. Thank you.